For so many of us in India, our savings have a default home, the bank fixed deposit. I mean, it feels safe, right? It's simple. But what if I told you that safety is kind of an illusion, one that's actually costing you real wealth? In this explainer, we're going to dive into why you really need to look beyond FDs to actually grow your money. Okay, so this sounds like a trick question, doesn't it? You look at your statement, you see the interest adding up, the balance is getting bigger. But here's the catch. While the number of rupees might be going up, the actual value of those rupees, what you can buy with them, could very well be going down every single day. And that right there brings us to the single most important idea we're going to talk about today, real return. You've got to forget that flashy interest rate the bank advertises. Your real return is what's left after two silent wealth destroyers, inflation and taxes, have taken their cut. This number, your real return, is the only thing that tells you if your money is actually growing or quietly shrinking. All right, so let's get right into it. Look, a fixed deposit isn't a bad thing, not at all. But it has this one fundamental problem when your goal is to build wealth for the long haul. I want you to think of it like this. Your money is in a race. Inflation is this constant headwind, always pushing you back. And taxes? Well, those are the hurdles you have to keep jumping over. And your FD, well, it's in the race, it's trying, but it just wasn't built for this kind of track. So let's put some real numbers to this, okay? You see that 7% rate from the bank, and you're thinking, hey, not bad. But wait. Let's say inflation is humming along at 6%. Poof, your real gain is just 1%. And oh, we are not done yet. That 7% interest gets taxed based on your income. If you're in, say, the 30% tax bracket, your actual return plummets to just 4.9%. The bottom line? Your money is earning 4.9% while the cost of everything around you is going up by 6%. You are quite literally getting poorer. So, if the good old FD is losing this race, how do we actually win? Simple. We need to find investments that are actually built for this race, investments that can outrun inflation and leap over those tax hurdles with ease. And when you put them head to head, the difference is just, wow. Okay, look at real return. FDs, low. Market investments, high potential. Then there's taxation. FDs are, frankly, terrible here. Market assets, much, much smarter tax rules. Even liquidity is better. You can usually get your money faster. And yeah, okay, risk. There's more of it. But it's something you can manage. And honestly, it's the price of admission for a shot at real growth. And this right here is the real secret sauce. You see, earning, say, 12% instead of 6%, it doesn't just double your results. It's way bigger than that. It supercharges the magic of compounding. The higher your return, the more explosive your wealth grows over time. This, my friends, is how you build genuine, long-term wealth. Okay, I can almost hear what some of you are thinking. This investing stuff sounds complicated. It's too much work. That's probably the biggest myth out there. So let me introduce you to your new best friend for automated investing, the SIP, or Systematic Investment Plan. Seriously, it is this easy. Just 3 steps. Step 1, you pick a simple, broad fund. Something like a Nifty 50 index fund is perfect. Step 2, decide how much you can comfortably invest each month. And step 3, you set it up to automatically debit from your bank account. And that's it. You're done. Your wealth creation is now officially on autopilot. And here's the best part about using an index fund. You don't have to be a stock market genius. You're not trying to pick the next multi-bagger. You're just buying a tiny slice of the 50 biggest, most established companies in India. It's not a bet on one company. It's a bet on the Indian economy as a whole. All right, let's switch gears. What about another all-time Indian favorite, gold? We love it, it feels safe, but let's be honest. Owning physical gold, it's a pain. The storage, the security. Thankfully, there are much smarter ways to own it now. So really, you've got 2 fantastic digital options: sovereign gold bonds, or SGBs, and gold ETFs. Gold ETFs are super straightforward. They trade on the stock market just like a share, and their price moves with the price of gold. Easy. But SGBs? SGBs are something special. They're issued by the RBI, they track the gold price, and they pay you an extra 2.5% interest every single year. Think about that. You're getting paid a bonus just to hold gold. Okay, we've talked about returns, we've talked about convenience, but now we come to the real game changer, the thing that most people completely ignore: taxes. And believe me, this is where market investments don't just win, They lap FDs. I mean, just look at this. The difference is night and day. With your FD, you're losing up to 30% or more of your interest. But with long-term equity gains, it's a flat 12.5%. That's it. This one single difference can literally add lakhs and lakhs of rupees to your final corpus over the years. But wait, it gets even better. For equities, there's this incredible tax shield built right into the rules. Yep, you heard that right. Every single financial year, the first 1 lakh and 25,000 rupees you make in long-term profits from your stocks or equity funds is completely tax-free. Think about that. It's a gift. It lets you book some profits every year without paying a single rupee in tax. And just when you thought it couldn't get any better, let's talk about the tax shield on sovereign gold bonds. Honestly, this might just be the single best tax break any regular investor can get in India. Zero. Zilch. Nada. No, that is not a typo. If you buy SGBs and you just hold them for the full 8 years until they mature, any money you make because the price of gold went up is 100% tax-free. It is an absolutely unbelievable, unbeatable advantage. Whew, okay, that was a lot of information, I know. So let's boil it all down into a super simple, low-effort action plan that you can literally start today. Okay, here it is, your first steps to building real wealth. Number 1, go and start a monthly SIP in a simple Nifty 50 index fund. This is for your long-term goals, so remember, hold it for more than a year to get those tax benefits. Number 2, for the gold part of your portfolio, make sovereign gold bonds your go-to choice. You want that tax-free growth. And finally, number 3, let your FDs do the job they were actually made for. Use them for your short-term emergency fund, not as your main engine for building wealth. So I'll just leave you with this one final thought. Is your money just going to sit there in the bank, getting weaker day by day? Or is it going to be out there, working hard for you, outpacing inflation, using smart tax rules, and actually building the future you want? Really, the choice is all yours.